All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. When the market's in kind of, just moving 10, 20 points a day on average, you oftentimes hear me kind of talk about predictability in the market and the fact that from a trader standpoint, I don't look at it as predicting. I don't think the market is highly predictable. I think there are patterns. I think there are events. I think there's things you can analyze to say, okay, this is the more logical path or this is the more logical progression of things. But the reality is when it comes to the market, you've heard that phrase that it makes the fools out of the majority of the people, right? And it is something where there are millions of experts. There are millions of analysis techniques, all developed to analyze and to predict and everything else. And the reality is, while yes, some things predict from time to time, to have something to predict all the time, no. And so you look at what is predicting and the numbers. Most of the time, it's just the same as throwing a dart against the wall. And I oftentimes get asked why do you even trade if you believe that? Because I do truly believe that the market is not predictable in terms of, I can go find highs and lows and ups and downs, and I'm going to use this tool to find this bottom and this tool to find this top, and I'm gonna figure out which way this stock's going to move all day every day. It's just not realistic. I've never seen anyone do it. I've never even seen a computer do it. Market makers can't do it. It is the market is a living, breathing organism, and it's fascinating to me and always has been. I do believe that you can set up good risk-reward scenarios. That's what I believe, and I do believe that with options there are times and places where you can step in, you can have the odds in your favor, you can have a defined risk, a generous reward ratio, and you can step in on those. Doesn't mean you're going to be right, doesn't mean it's going to go your way, doesn't mean it's predictable, but you can have a good risk-reward scenario. And so as I look at the market, right, and as I talk about the market and as I note different things down, you'll oftentimes not hear me talk about predicting. You'll hear me talk about what? Are there risk-reward scenarios here that are setting up? If this happens, then it would be an interesting risk-reward scenario, right? That is the way that I look and digest the market. I know that's not the norm. I know for most people it's about tops and bottoms and picking this and which way is this stock going to go tomorrow, and oh no, is the market going to go up or down 10 points from here? And if it does, what does that mean? And if this level breaks, what does that mean? And it's all about interpretation and predictability. But I think both of those kind of go down a slippery slope, because the reality is we can interpret meaning out of different things. But that's not always doesn't always lead to a predictable action. I want to show you some time period here in the market. You see me go back to different time periods, from time to time. But let's go back. Let's just go back to 2007. We'll rewind here. Here we go. And let's get rid of all of our indicators, because in hindsight, indicators work phenomenally, right? They work so well. All right, but here we are. Here we are, and the S&P trading at 117 on the SPY. Right, so 18 to 19 to 20 point move is 1%, or excuse me, a 12 to 11 to 12 point move is 1%. And we could look at market breaks into a new high right here and breaks on down and drops, and then it has this gap up and rally, and then huge rally and drops. Then there's this kind of reversal on this day right here. I mean, the market's been ugly. It had this really big down day. Market was down what was it, like 4% or something this day. And then the next day it gapped down, it sold off and rallied back, and the bulls were in charge. The next day, gapped down, sold, rallied, bulls are in charge. All right, you know what? This thing's ready to go. Here we go. We're breaking into new highs. Bulls are ready to go, right? Technical analysis, breaking into new highs. We have some positive divergences, everything. It's and whoosh, right back down. Right back down. And then the next day sells off. Next day gaps up, sells, and here we go, down, down. We're breaking into new lows, and then we come all the way down, and yes, the market traded all the way down here. Remember vividly the day. It traded all the way down here, and then rallied all the way back. The next big day was a big gap up, and, you know, you see the chop through it, right? I mean, it always looks kind of smooth when you look at it in hindsight, right? Like, oh, yeah, there was the bottom, and boom, up it went. But it's never that way in real life and in real time. And even experiencing the market at this time, you know, that wasn't the case. And one of the things that happens in these environments is the interpretation and the analysis tends to go up. And one of the things that I would contend is that these are the times where the interpretation and the analysis needs to go down. Where to look at something and to say, well, it's doing this, so it means this, it means this is going to happen going forward, is actually makes even less sense than it does in a normal time period. Because many times during these fluctuations in the market, it's about emotion, it's about fear, panic. It's those types of swings. It's a teenage daughter going through an issue at school, and 1 minute she's high as a kite, and the next minute she's low as could be, and it can swing every two to 3 minutes, right? There are things that happen during these time periods that do offer a little bit of level of predictability because we've seen them before. It's happened before. When it happens, chances are this is going to happen, and you can try to take advantage of that a little bit, right? That does happen. But it's not something where every 20, 30, 40-point swing has that type of interpretation. And one of the things you see during times like this, just turn on the TV. Turn on the TV. Listen to some of the analysts. Listen to some of the traders. Listen. There's a level of frustration there. It's a high level of frustration. Is it because the market's so different? No, the market's been through these periods a million times, and it'll be through it many, many more times in the future. But one of the things that's happening is they're trying to find meaning. They're trying to find predictability in what's happening. And a lot of times what will happen is people will start to micro-analyze during these time periods. They'll actually increase the analysis. Well, this is going on here, and this means this, and this is doing this, and this is doing this. And there's 18 billion pieces of information coming in, and boom, all of a sudden, boom, it moves. And wait, now it's reversed, and wait, this one's doing this, and this one's doing that, but it's not doing this. Yeah, they try to take an IBM, and they try to say, you know what, IBM, I mean, come on, the market was down 70 points yesterday, and IBM was down $1. I mean, it was so nice. And then the market rallied back, and IBM rallied back. That means IBM has to go. Really? Does it really mean that? Is that what it means in these time periods? No. Historically, no. Just because you outperform one day doesn't mean you outperform the next day. I like to look at the outperformers, but you'll notice I don't just go and chase the outperformers on a day like yesterday. With the market today, and with what's been going on this week and what's been happening, this morning I mentioned this 2670 level, right? A level that was what? The overnight lows. Why is that important? Well, what do we tend to see? Well, when the overnight lows get broken, we tend to see further selling. That's not a, hey, this is going to happen today. This has to happen today. This is, well, they break and down we have to go. But that is a tendency, right? That is a market tendency. And there are lots of tendencies out there, right? And we talk about those tendencies. And in this case, hey, this tendency is holding true. Does it mean that every one of these tendencies are tradable with an option? No. Does it mean everyone's comfortable trading a certain tendency, every time? No. Does it mean every stock has to fall with this tendency? No, it doesn't. Right? But there's a difference between tendencies and predictability. What happens if the market comes down to yesterday's lows? What does that mean? Well, why does that have to mean anything? I mean, let's face it. Why does there have to be any meaning in that? I mean, we just go back to, right back here. I mean, the market hit retested the lows, and then it hit new lows and broke the lows and only snapped back. I mean, fine, if it breaks the lows, was there any meaning in that? When we look at this right here, I mean, it broke the lows. Does it mean anything? I mean, here it broke the lows again. Does it mean anything? It's one of those things where in a market like this, what do we know? Well, we know what some of the tendencies are. We know that heavy volume can create moves, right? We know that when tech stocks start to strengthen, the bulls tend to have the advantage, and when tech stocks start to weaken, the bears start to have advantage. And we saw it yesterday. Even when the market was down, the tech stocks started to improve. And what happened to the market afterwards? And today, what happened? Tech stocks, they weren't keeping up on the rally. They started to then fade. What happened to the market, right? We know that is a tendency in this market. Okay, it doesn't mean that, hey, if tech stocks are outperforming by X% over the course of X time period, that this has to happen in the market or anything like that. But no, we know there's a tendency there. We know what? We know that the market right now is looking at the trade war, and investors don't have their normal tools. Fund managers don't have their normal tools. Does fundamental analysis have anything to do with the price action in Caterpillar right now? Anything? No. Fundamental analysis is what most investors use, what most money managers use. Do the charts have a lot to do with it? Well, it's broken a lot of charting tendencies. I mean, this chart literally over the last 3 months looks like a 2-year-old drawing with a crayon, right? I mean, that's what it looks like. You say, well, okay, you buy the gap ups because it's going to go up. Well, we can find gap ups that went up and gap ups that went down. We can find gap downs that went down and gap downs that went up. I mean, we can pull a whole Dr. Seuss here and find any and every combination of scenario. From an investor side, from a hey, you're managing your own money side. It's a market, okay, where you have to turn off some of the headlines. You have to look at stocks as you're comfortable with. I mentioned Alibaba, right? Because on Monday, I mentioned that I trimmed a sizable portion of my Alibaba. Not everything. But Baba has been pretty good to me this year, even though I've been mostly on the long side. But I've been fortunate with some of the bounces and everything else. But I used it as a point to trim. Did I know it was going to pull back? I had no idea. I knew it was a possibility. I started to put a little bit back on, but not much. I just sold some 140 puts the other day. Tuesday. Stock's a little lower than that, right? Stock's a little lower than that. But, hey, that's where I'm comfortable stepping in. Am I trying to analyze and interpret, oh, well, today it was up a little and now it's down. What does that mean? Or what does that mean for my position? No. Because what's that going to do? That's going to get me a straitjacket right away. right? That's going to give me a straitjacket and a padded room. That's all it's going to do. It's going to drive me insane trying to interpret all that. Oh, man, let me pull up the news. Let me see what everybody has to say on it and all of that. It just gets oppressive. So from a money management, from a that standpoint, you look at levels that you're comfortable with and exposures that you're comfortable with. And we've talked about those things many times over the past years. From an option trading standpoint, nothing changes. Absolutely zero changes for me. It's about risk, reward, and exposure, right? It's about risk, reward, and exposure. And when am I willing to increase exposure? Well, I'm willing to increase exposure when I see a tendency that I like. When I should I say it, when I think there's a little higher probability or predictability. I know it's not predictable, but the odds fluctuate, right? The odds fluctuate. Chances of up or down based on past patterns, that changes here, okay? What's been my exposure through a lot of this? Been very light. Why? Well, one is because the predictability has really kind of gone out the window. Right, it is very much coin flip type situations and a lot of things. And I've stepped in, when we've seen some of the technical setups that I like. I stepped in on IBM at the lower band, and okay, didn't ultimately work. All right, take a small loss, move on. But I've only stepped into situations where the risk reward was strongly in my favor, where I had a lot of reward potential. But one of the things right now is finding good risk reward right now today, pretty tough. Option values are pretty insane. So I have a market where predictability or probabilities are low in terms of the skew, right? It's 30% chance it goes up, 30% chance it goes down, 30% chance it consolidates, and 10% that it'll do something different. Okay, right. I mean, you get the point. But overall, there's not a high level of probability one way or the other. And looking and going, well, if the market moves 10 points right here or 20 points or breaks this level or adds this level, then that changes. Yeah, maybe from time to time, but not most of the time. Most of the levels haven't really mattered. Most of the 20, 30-point moves haven't really mattered. Most of the ones going forward aren't going to really matter. We're ultimately going to see, in almost every type of pullback scenario, we ultimately see something pretty darn dramatic that leads to a bottom. We haven't really seen it yet. Yesterday was a nice reversal, and it was definitely a bullish one in many regards. But was it the type that, new low, reverse off new low, everybody's thrown in the towel already and everybody's out, and now it's only people after to get in? No, it wasn't that nature. So I had to be cautious and look and go, okay, you know what? Do we see signs that, yes, yesterday was the low? Well, this morning they didn't materialize, right? They didn't materialize. So, okay. Now I have to look back at it again and go, okay, can we go to new lows? Absolutely, that's possible. In fact, some might argue it's probable. But I have to look and say, okay, from here, am I willing to put any money on the line, any exposure with the risk-reward environments that are out there? That's nothing new. That's the same question in every market, every day, every trade from an option standpoint. And so the market environment doesn't change that. The market of you could argue it's just as hard to find risk-reward exposure scenarios right back here when the market's not moving, right? It's not one of these things where, oh, well, you know what, because the market's moving a whole lot, well, there isn't any, or because it's not moving, there isn't any, right? They change from time to time, and the way different people will interpret things, and what is a great opportunity to one person is not a great opportunity to another. And so it's not something where I look and go, wow, this market, I got to go cash. But it's one where I know that if I hold on and try to be patient, the risk is to zero in every single trade. Bank of America, IBM, and I'm not willing to take that risk. Not yet. Because I do not think that there is enough of an absolute bottom in this market. Ultimately, I do believe market goes higher. But ultimately, I understand the environment that it is. And I understand there's not a huge predictability level. And trying to find interpretation or meaning out of everything, you'll hear me comment on things. But even this morning, I made a comment, and one of you asked me about it. I made the comment, IWM outperforming this morning. That tends to be pretty good. Did I trade based on that? Did I go and do something based on that? No. I'm not willing to add a lot of meaning to things. And so it's a observation. You observe what you like, you observe what you're looking at, and when you see something that you go, hey, you know what? Risk-reward probability is in my favor. All right, do I want to put some exposure? Right? And that's nothing different from any other market. There have been several things that I've looked at today, and I really like the probability of movement. I suspect that I'm right on the probability of movement. The only problem is I have to be right, and I have to be right in a big way for the option to pay off, because if I'm wrong, even if I'm wrong, if I'm wrong and I'm wrong early, I'll probably take less of a loss than being right and being right late. And that's just the way the options are set up right now. They're not set up to have any sort of real patience with them because of some of the implied volatility bleeds, that are out there. And we probably see the market hold up today. We probably see the market close somewhere within yesterday's range. Does that have meaning on what happens tomorrow or Monday or Tuesday? In this type of environment, I don't believe so. In this type of environment, I think you need to see one of two things. You need to see a dramatic piece of price action. A dramatic piece of price action. What do I mean by that? Something where you turn on the TV, everyone's just shaking their heads and going, wow. We haven't had that yet. We haven't had that. I mean, even the selling that we've seen this week, that was all within the prior week's range. Right? I mean, the market, from where it closed, from where it was, last week, early last week, market's at the same levels as early last week. This has been the normal type of move throughout this correction. Yeah, we saw a big down day. Okay. Yesterday was down 70 points. Is that a huge wow? Look at the volume. Right? It was elevated volume, but it wasn't wow type of volume. Maybe we get down on the market, gaps down Monday, flushes down to 252. Would we be in a wow situation then? Yeah. Yeah. Absolutely. All right. If and when the market gets in a wow situation, yeah, we can start to look at past situations where that has happened and say, you know what? All right, the market's overdone, market's oversold, market may have bottomed on this. All right, do I want to go put some exposure based on that, right? And then I have to ask that next question. Because the reality is we get a wow day and then we get another wow day, right? And I don't know if there's a technical indicator that I can put up or show of all the thousands that there are that's going to tell us that after this wow day that there's not going to be another big wow day. Right? In terms of just saying, well, if it does this, then this has to happen. No. But what have we seen a lot of times? That after major corrections, we have seen a flush into new lows, and then we have seen a wow type of rebound and rally. We haven't flushed into new lows. So I'm not really looking at that tendency. And I look at yesterday and go, okay, yep, short term we're oversold. Yep, we get that rebound back. Yes, we saw the bullish flow in tech. But is this that wow moment of, man, the absolute bottom's in? Oh, no, it's still within. I mean, let's face it. In hindsight, this is going to be called a consolidation period, right? I mean, that's what it's going to be called. It's going to be the same type of period that this is called right back here in February, March, April, consolidation, right? That's where it's at. That's where it's at right now. And if and when the consolidation breaks down to the low side, there's going to be a lot of stops that get triggered, a lot of stops that get blown out. And if and when this upside level breaks, there's going to be a lot of downside stops that blow out. There's going to be a lot of buyers that step in on that break. But that's an 18-point range here on the market, 7-point range here on 7% range on the market. That's a pretty hefty range. And so looking at 20 and 30-point moves and looking and saying, well, if the market climbs back 30 points into the close, then it means we have to go higher. Or if the market sells off 20 points more into the close, it means we have to go lower. It's just not very logical, right? It's not logical based on what's going on right now. It's not logical based on past history. And it's overreaching. It's interpreting meaning when there may not be some. So one thing that will give some meaning is a wow type of action. And I mean wow, not just, ooh, that was pretty big. Wow in terms of getting outside these ranges and just doing something that is pretty spectacular, even in the context of what we've seen over the last 2 months. The second thing that is needed, okay, and generally the wow doesn't have a catalyst. In fact, the wow tends to be counter catalyst. The wow tends to be, if we get that big down and big drop and then big reversal, we'll probably have a negative catalyst that drives it down and no catalyst driving it up. Similar to yesterday. Okay, similar to yesterday in terms of the catalyst. There was no real catalyst driving it up. We just saw the money rotating a little bit differently. But yesterday, I don't know that we can call it a wow day. It was still within the range of the prior week. So first thing, wow. Second thing is just some sort of game-changing catalyst. A game-changing type of catalyst. A lot of times, and we did not see it back here in February, March, and April, but if we go look at 2012 and 2011 and 2007, we look at some of the corrections that happened during those time periods, a lot of times there was a wow day, and the next day there was a big positive catalyst, a game-changing catalyst. And it's one of the reasons why yesterday into the close, I got on video and I said, look, I'm not buying into this, but I'm willing to buy a gap up. Because a gap up would need a catalyst. And if there's a really strong catalyst, okay. But what wasn't there this morning? There wasn't a big, strong catalyst. I know jobs report, whoop-de-doo. To me, jobs report is not a catalyst for major change and wow in the market. I do understand that the TV makes a huge deal out of it, and, it's the be-all, end-all to everything. But it's one of those things that, no, that is not a catalyst, right? We saw in the U.S. President Trump when he was elected and the market dropped and then rallied on back, had one of those just wow, aha, big types of whoa. S&P futures were down 100 points overnight and they were green the next day, and then the next day gap up, and there was that major change catalyst that occurred. You don't always know what the catalyst is going to be, but you oftentimes know there needs to be a catalyst, right? And so you'll notice I'm not sitting here saying the market's going to go down tomorrow. The market's going to go up tomorrow. Market's going to do this because of this. I'm not sitting here pulling up S&P futures charts and going, oh, you know what? We just rallied since I've been on video 2042 up to 20. Man, this was a 25-point rally right here. 25-point rally in a matter of 20 minutes. A point a minute, right? Does it mean anything? Am I going to try to find meaning into that? No, I'm not. Right? I'm not going to put myself, through that. Ultimately, yeah, we could go lower. Yep. Ultimately, we could go higher. But I don't have one of those two things. I don't have a wow moment, and I don't have a catalyst. As I look at put options, right? As I look at put options and say, well, do I want to run with these? Right? Are they much safer than calls right here? Well, no, the pricing is sky high on both, right? It is really sky high on both. Bank of America is lagging JP Morgan. It's underperforming JP Morgan. What am I going to read of that? Am I going to try to analyze that? Say, well, because JP Morgan is outperforming Bank of America, no, I can't in this environment. Why? Because you know what? There's a lot of forced selling that's happening in this environment. You think there are fund managers out there that are going and saying, oh, I'm going to sell because I want to, or because I really think this stock is now garbage? No, they're getting knocks on their door from their risk manager saying, look, you've got to cut. So they're having to look at some of their favorite exposures. They're having to cut them. Well, which stocks are they going to buy back when they're allowed to? Yeah. Some of those laggards, some of those underperformers that were their favorites. So, to say, well, you know what, JP Morgan, to make those type of analysis types of things in this environment doesn't make a lot of logical sense. Boeing's outperforming today. Does it make a lot of logical sense to infer what it's going to do tomorrow? No, not really. But can I take Boeing and say, you know what, it's outperforming today? I had a nice reversal yesterday. It's holding on here today. I've seen this before. I've seen this. In fact, I've seen this right back here. Take a look. I mean, Boeing, beautiful reversal off the low right here just a couple weeks ago. Then the next day, it gapped up and went higher, and it sold off. And then, even the next day, what did it do? It went lower. Just before a big move up. Huh. Okay, I've seen this before. We have a nice reversal yesterday, right? Today a little higher, now trading on lower. All right. What do I need to kind of feel comfortable that maybe there's a next big move up? Well, you hear me talk about it all the time. A gap, right? A gap, a significant gap. Here we had a significant gap, right? Or a fresh move above the 7-hour, right? Well, now that we've kind of dinked around down here, we've had that wow move. Now we're pulling them back. Fresh move back above 7-hour. All right, I'm willing to go put some money on the table. I'm willing to go say, you know what? I may have a risk-reward exposure situation that makes sense. I don't know if that's going to happen. I can't realistically look at my chart and say, well, because it played out this way right back here, it's going to play out the exact same way. In fact, the odds are it's not going to. But there are principles in terms of the gap and principles in terms of the 7-hour that have stronger tendencies than other things. There is always a trade in the market. There's always a trade to be had. There's always something for somebody. But in some periods of time, it's much more of a coin flip than others. And unfortunately, market coin flips are not 50-50. Not for option traders. Market coin flips for option traders are 33, 33, 33, and maybe even a little bit lower than that, depending on the implied volatility. When I go through my watch list and I look at some of my favorite stocks and some of the things I'd like to be involved with here in this market, a Nike, for instance. Good risk reward, Good predictability? Probability? No. None. There's not good option value. There's not good probability based on the chart. There's not good risk reward, even based on, hey, if I just say, hey, this is going to go up or this is going to go down, not really good risk reward associated to it. And as I go through my watch list, the majority of things, unfortunately, right now are a Nike. Could that change this afternoon? It could. It probably won't change on a 30-point rally or a 30-point drop. It'll probably take a lot more than that to change that element, to change that context. AT&T, right? Could I be a buyer of AT&T here, use yesterday's lows as a stop? I could. I can at least get a little bit of a risk-reward scenario there, right? I could get a little bit of that. Probabilities in my favor? No, directionally they're not. In fact, most of the chart elements and most of the technical elements, they scream consolidation, not big up or big down. And so I have to look at it and say, okay, well, I'll wait. And I don't know exactly what I have to have, right? And exactly what has to transpire. Because you know what? We could see a catalyst this afternoon that changes things. We could see a catalyst Monday morning that changes things. We could see price action this afternoon that changes things. But what am I looking for? I'm not looking to interpret the meaning of it. I'm not looking to predict it. I'm looking and saying, all right, does this bring my risk-reward level into a place where, okay, I can go have a good risk-reward in a more probable situation. Now I can decide on exposure. And right now, that probability side is so, flip a coin that I'm not a huge fan. And even if that weren't the case, the risk reward on so many things is so bad. There are a few exceptions like AT&T, but not there where I want to jump in just yet. But again, could change in the next little bit, based on what's going on and based on what's happening. But to try to find and to try to interpret meaning in all of the moves in this market from a day-to-day, hour-to-hour, minute-to-minute basis is going to lead to the same frustration, the same aggravation that you see in the fund managers' faces when you look at the TV, when the analysts' faces when you turn on the TV. And, for me, that's not what the market's about. For me, that's not what's very fun. I obviously want to always be in trades and always winning trades, but I know that's not what not what it's about. That's not what is realistic. But I do know that, if you take risk-reward exposure, you can navigate through any market. And with the challenge, $3,000, navigate through the market. We're right on a few things. Boom, it can, inflate very, very quickly, very, very rapidly. And if we're wrong, it can go to zero and it stinks. But at the same time, we're not putting $100,000 out there into play. Thanks for hopping on. Have yourselves a great one, and I'll keep my thoughts posted there in the message feed. We'll talk to you later. Take care.